In my opinion, we are in the 7th or 8th inning of this quote credit cycle. And I will make one other comment. We have seen the highs in the S&P for at least the next 6 to 9 months.
Whoa.
You have one of these weeks with so much good stuff to chew on as investors. You've got tons of macro with major central bank meetings, non-farm payrolls, and you have tons of micro with 34% of the S&P reporting this week. As an investor, I've learned slowly and painfully over the years that you always want to look at both.
A warm welcome to the On the Tape podcast. I'm Guy Adami. Danny Moses, how are you?
I'm good, man. How are you?
You were singing earlier. You'll spare us, but I like it when you sing.
Very good.
Dan Nathan's here.
I'm doing great, Guy.
We're going to be
I
joined.
didn't ask you how you were doing. You said,
No, I'm just telling you I'm doing great.
Okay.
We're going to be joined later by Rebecca Patterson. You all know her. You remember her from the Money in Motion days, perhaps.
Correct.
But Rebecca's a great voice, and given what's going on, it's a perfect time to have
she also had a great op-ed yesterday. That would have been Wednesday, July 31st in the New York Times opinion
publication.
Section. Yeah, it was really good.
When I was a young lad, I think it's 1976-ish, I was a rock and roller. But every once in a while, like a pop song would sort of come out of nowhere. There was a song by Vicki Sue Robinson. You familiar with Vicki Sue Robinson? Danny?
Nope.
Yes, you are.
I mean, I will when you tell me what song she sang. I'm going to remember.
Her one and only hit in 1976 was Turn the Beat Around.
Yeah.
Remember? Love You Here. And what we're seeing here effectively over the last couple weeks now is the market sort of turning the beat around. Things are starting to turn, and it's turning on a number of different fronts. Forget about the intraday turns we've seen in the S&P 500 and the NASDAQ, and they've been vicious. We saw our first down 2% day in the S&P 500.
After 350 days.
And we're starting to see moves to the upside, moves to the downside. As we're sitting here on a Thursday, we have a VIX that's north of 19. So a lot of things are turning around. Let's start with the reasons why, Danny. And I think a lot of this, as much as everybody wants to predicate things on AI and revolutions and money flows and all that thing, if you think about it, the stock market is still predicated on a number of different things. And at a certain point, the economy matters and the relative strength of the economy matters. And what we're seeing in terms of interest rates, predicated, again, to use the word, on the ISM numbers and some of the weakening data, I think is eye-opening. So let's start there, Danny Moses.
Yeah, listen, look at oil to start with. All this geopolitical stuff happening in the Middle East, yet oil continues to struggle to move higher. It's kind of been range-bound. Now it's drifting. The China data is being completely ignored by all the other things going on in the world, all the central banks, which are taking action right now. But the Chinese manufacturing sector is weak and getting weaker. The ISM, the U.S. manufacturing sector, is weak. That ISM print for the month of July was horrendous. We won't go through it all. And what I've been saying for the last year has been fear the day that rates start to drop and the market drops with it.
All right, stop right there, because in a snapshot, that's exactly what we're seeing here today. Today being Thursday. We've said for a while, be careful what you wish for in the form of lower yields, because if they're going lower because things are slowing down in a precipitous fashion, the market's not going to like that. Now, again, I don't know what's going to happen next week. I don't know what's going to happen over the next couple months. But what I'll tell you is today, Dan, is a window into what can happen in terms of lower yields on the back of slowing growth.
Right. So we have the S&P is down 3% from its highs just after the opening. I think folks were kind of a little feeling better about some of these mega cap tech earnings, right? After we had Meta last night, after NVIDIA absolutely ripped on that Microsoft guidance as it relates to CapEx, Meta actually reinforced some of that stuff. And so if you think about the Fed meeting yesterday, fairly well telegraphed, right? That September was going to be a 25 basis point cut. The CME Fed Funds Tracker was telling us that. And to your guys' point is like, you guys have been saying this for a year, right? When the Fed actually starts cutting, that's when you have to be worried, because the pause period is generally pretty good for equities. And so when I think about this is pretty fascinating, guys. Last summer in July, the high to the lows in October started at July 18th. The high this year was July 16th.
Stop it.
Okay, when you think about the move that we have had off of those highs. We're about 5%, okay, from those highs. We had about a 10, 11% drawdown until the end of October. But what feels different about this time is that we already started selling off into earnings, okay? And we're already down. And the fact that we're about to make a new low here from the other day, I think, led by semis, I think is really interesting because that's clearly been the outlier of semiconductors.
So what we've talked about, Danny, and what we've said is bad news. The market has wanted bad news because bad news suggests that the Fed is going to be accommodative at some point, and bad news will sort of foster in and wave in this round of Fed rate cuts. So for a long time, bad news was good news for the market. It appears as though over the last week and a half or 2 weeks, bad news is starting to be bad news for the market as well. So bad news is in fact bad news. And layered on top of this, by the time you're listening to this podcast, we will know what the unemployment rate is. I've been saying for a while, I think the rise in unemployment is going to surprise people to the upside. There are a number of different reasons why. These revisions to the numbers have been eye-opening. Thoughts on that? Are we finally reached that sort of point? We're turning the beat around where bad is actually bad.
Look at the earnings, not even the economic data. But yes, the trend now is in the other direction. So jobs have one way to go. And you might have fits and starts where you get a good jobs number here and there, but we are in one direction. So that to me, that is completely cemented at this point. So I actually believe the Fed's going to go 50 basis points in September. And I think they're going to signal that in August since there's no meeting. But when they're speaking Jackson Hole, I think you're going to see it. When I look, again, to go back to kind of 99, 2000, right? When tech started to sell off, what's the buy point? You would get these intermittent rallies. Go back to 2006, 2007. There's a great article in Barron's comparing the exact correlation of the S&P in 2006 and 7 to right now, lows to highs. It's 85% correlated to what happened. And that's just behavioral finance aspect. It's really nothing else. But the point is this, it's now almost 4 rate cuts built in for 2024. We are about 3.5 rate cuts now in Fed fund. And that in a 1 month period, we've changed drastically. We've added 2 cuts basically. So 1.5 to kind of 3.5. So the answer is with the market trading where it is, 25, 50, even 75 basis points of cuts for the Fed is not going to do anything. And I look at the names, we talked about this on Fast Money a couple weeks ago, in auto, in credit cards, the things that are happening to the consumer, right? They've kind of hit this breaking point here, and it's not going to help them. And so you're seeing it now seep into earnings. We're going to talk about some of those names here. And so Fed can only do so much. I think they need to start cutting and need to start cutting.
Yeah, and one thing, Guy, and you and I have talked about this a little bit. Right now, if you look at the consensus estimates for S&P 500 earnings for 2024, it's near 11.5% or so, and then it's supposed to ratchet up to about 14.5% in 2025. So how can that be? If you look at the weakness in the consumer, not just here, but also China, okay? Like how many warnings did we hear from U.S. multinational brands about weakness in China? So, that engine of growth there is not humming along by any means. And so everything's being held up by the high-end U.S. consumer. And if we lost the low end, we've seen a trade down in the middle end. At some point, you have to see some degradation in the spending power on the higher end.
So anecdotally, and people will say you guys cherry pick, and that's, I guess, true to a point, but it's not because we try to look at a wide range of things. But we obviously are trying to look at things that sort of make sense to us in the context of some of the theses we've had. Wayfair, Dan, you want to talk about this? The CEO likened the slowdown in home goods to what he saw in the financial crisis. So that's, again, anecdotal, but not necessarily because we're seeing it across a lot of different retailers. We're hearing it from the low-end retailers without question. We're hearing it from McDonald's, Starbucks. I mean, Hershey's. So speak to that.
Well, it's just giving you the overall mosaic on kind of what's happening. And there is not really any sector, with the exception, as Dan just mentioned, of maybe tech and AI that are kind of out there that have been insulated from this. And when you look at Meta, give them credit. That was a great quarter. And it is the cheapest relative of all the large cap tech names. I mean, it's not that expensive relative, and it's growing, and it probably earns that valuation. But what they're doing, they are disintermediating many sectors at one time. They're using their 3.3 billion users, and they're completely destroying all the traditional ad agencies. So you have companies like that which are making secular changes. But Guy, I'm looking at a name like Credit Acceptance Corp. It's a $6 billion subprime auto lender, right? They basically lend to used car dealers. It's the bottom of the bottom. And they're seeing a sharp uptick in late payment delinquencies, so forth. So you're starting to see this thing kind of creep through. And yes, the bigger banks, as we've seen how they've been performing, they're well reserved, obviously, for something like this. The KRE, which I know we're going to talk about here,
regional banking
has had a
index.
massive reversal here from the highs. And Dan, I know you guys have been talking about a market call, but just put it all together, Guy, is what I'm saying. And we've already been seeing inklings of this, but I think the Fed, as we get through the rest of this earnings season, it's going to become very clear. I think that we're
so
slowing
Credit
down.
Acceptance Corp, for you that don't know it, the symbol is CACC. It's a $6 billion company. It's a stock that basically, I want to say at the middle of July, so half a month or so ago, was north of $600. As we're sitting here today, it's below $500. So not an insignificant company. You've seen fits and starts along the way with this name without question, but there are certain stocks that are going to sort of signal what's going on below the surface that nobody wants to acknowledge or nobody wants to sort of see. It's names like this. And there are other names as well. Now, if I'm being honest, you're saying you're cherry picking, I'll go to MasterCard and say, you know what? Surprisingly, Dan, that was a really good quarter out of MasterCard, and you saw the subsequent bounce in the stock. I don't know really what that was on the back of. What I've said for a while, and I'm curious as to your thoughts, Danny, as well. I'm thinking that the consumer is now trying to combat inflation with credit, and you're seeing it across a number of different things. That is an unhealthy thing, and at a certain point, it's going to have ramifications because they're not doing it because they're in such a good shape. They're doing it because they have no other choice.
Right. And again, that's transaction. They're not taking credit risk. So it's probably not speaking to a great deal of what we're thinking about. And it's going to be really hard to figure out until we see, let's say, month over month or quarter over quarter, a decline in that processing number. I guess the other point I would just make on the higher end, again, we know American Express does take credit risk, and that was making a new all-time high on Wednesday, right? Yeah. So a big reversal today. I think it makes sense to take a look at all those sorts of things, but I guess it's more important to focus on what we've heard from some of these consumer product companies. And Procter was a good one earlier in the week. A big move. I know it doesn't sound like a lot, down 5% the day after their earnings. For Procter & Gamble, that's a lot. The big takeaway there was their inability to continue to pass through costs or raise prices to consumers, Danny. So we're seeing this all over the place. And, this didn't get a lot of attention, but those disastrous numbers that we saw out of the automakers, and it wasn't just Tesla, it was Ford, it was GM, it was Toyota. I mean, the list went on and on. And so not only are you seeing a slowdown in autos being bought, but you're seeing an uptick in delinquencies.
Yeah, because to buy a car, finance a car, or lease, it went up. So the cost to own a car went up. I want to say one last thing, and I'll put this to bed on this Credit Acceptance Corp. And Guy, you just made a comment how this credit cycle's kind of been extended. Well, the buy now, pay later and things like that have been kind of the last mile, let's say, of credit. And I'm telling you guys that when you look at a firm, they're going to report later in August, right? I'm not telling you to go out and short the stock, but it's something you're going to want to watch. They pose themselves as a tech company, but they're a lender. And Upstart on the kind of lending side also, that's a tech company posed. They're going to be reporting, I think, in early August, and that's a stock I talk about a lot. Again, heavy short interest on both. But the point is that you can't reinvent lending. And this is kind of, if you want to grow right now, like Credit Acceptance did, when the banks were pulling back from auto lending, who was stepping in? It was Credit Acceptance Corp. So it's almost like last in, so to speak, and kind of first out. So you are seeing, in my opinion, we are in the 7th or 8th inning of this quote credit cycle. And I will make one other comment. We have seen the highs in the S&P for at least the next 6 to 9 months.
Whoa.
This 56.69, I believe, quote me on that, on what the number was. I think it was, we hit it. I don't see a situation where we kind of get back to that level. We have, again, the concentration in the big names. You are seeing, obviously, the lapping effect of AI ordering and so forth, and it's catching up. Dan, explain to me on the AMD quarter yesterday. Okay, it was good. The ordering was fine, but it wasn't enough to justify a continuation of multiple expansion within the sector. What was that?
Well, this one's
just
cheap
a relief
relative
rally?
to the other name.
No,
It's
I'm saying
been
they were
left
signaling.
out.
They were signaling the rest of the market.
I mean,
it.
about
Explain that to me.
18% of their sales is expected to come from generative AI, at least as the guidance that they gave. Their CEO suggested that $4.5 billion in Gen AI related sales, which is basically in line, Guy,
right,
to what the
like $100 million
expectations
more
were.
or whatever.
Stock gapped up 10% on that, but gave probably half of that back. And then today, the follow through down 9.5%. And I just want to spend a minute on this Meta quarter, because I think it's really important to understand that a lot of these companies that have been spending tens of billions of dollars, right, on these high-end GPUs and building out these servers into these data centers and the like, you know, when you think about Meta, they had already been spending on metaverse. This goes back to 2021. And a lot of that spend was actually reallocated towards generative AI. And one of the reasons why this stock has traded so well of late is that they are using this technology to serve better ads, right? And so that's been really important to them. And then if you look back to why Microsoft, after the close on Tuesday, while that quarter was being released, was down 7%, guy in the aftermarket, you and I were both on Fast Money. I don't think either one of us thought it was that disastrous of a quarter, but what we're hearing from them is not a big uptake in Copilot, okay, across the Fortune 500, if you will. And when you think about that, it's pushing out the monetization for a company like Microsoft, which only has the ability to resell. They don't have the ability in their own business to make it that much more efficient. And the last thing I'll say here is Amy Hood, the CFO of that company, on their call said they feel something like very confident that they will get the return on these investments maybe out 10 years.
Yeah.
So for you guys who are waiting for in months or quarters, you know, don't hold your breath.
The point we've been trying to make is none of us here have been denying the spend associated with AI. It's in the numbers. If you look at NVIDIA's reports, it's in their revenue numbers without question. Our concern has been, and then by the way, subsequently, people like Goldman Sachs, Roger McNamee, Sequoia, all made similar comments about their concern about the return on investment for that spend. And at a certain point, especially if there's a slowdown, customers and end users are maybe going to slow things down. And if you've seen the double and triple ordering, what's going to happen? It's at some point, it's going to impact the margins of a company like NVIDIA, who, by the way, enjoys 77% gross margins. I do think, and I've said it, you've probably seen peak margins there. When it turns, and it does for all of these companies, the turn is violent, and you're starting to see glimpses of it in some of these semi names. And everybody says it's different this time. It's not different this time.
Let me go back.
Semiconductor stocks.
No doubt. Let me go back to another comment that Microsoft made, and it almost seemed a bit defensive. They talked about the lack of acceleration and growth in their Azure and their intelligent cloud business. And they were talking about how they're capacity constrained, right? And they're also talking about how they think that they have the ability, once they've built out some of these data centers, okay, to basically get the GPUs in the future, right, to build out more servers, to do more training and the like. But here's the thing, there's a really good chance that we see all these hyperscalers, whether it's Google Cloud, whether it's Azure, whether it's AWS, that they have built a tremendous overcapacity, right? And I think it's important to go back to the buildup that we saw in the pandemic, that AWS, they were spending hand over fist. They were hiring like crazy. By 2022, they had massive overcapacity, and that stock actually got killed. So if you don't think that this could happen to some of these other names, if the CapEx starts to decelerate meaningfully because the uptake or the enterprise demand, whether it be in the data centers or whether it be for the services, doesn't materialize, then you're going to have a situation where you're going to see lots of guide down in the next couple of quarters. And that's why, Danny, I think you should have better confidence in that call, or greater confidence about the S&P putting a high in for the next 6 to 9 months.
Some other things that have been happening, and we don't want to get too in the weeds and make your eyes glaze over, or maybe it's too late for that already. But if you, Danny, and this is something that you and I have both been laser focused on, it's what's going on with Japan and the intervention there, the subsequent now another rate hike in Japan, the move in dollar yen from, again, 150 up to 160, intervention in April, down to 152, back to 161, another intervention on the back of a CPI number here in the United States from 161 to 157 in 5 minutes, and now this move below 150. So people will say, okay, why do you guys make such a big deal of it? This whole yen carry trade, which is risk on, risk off, might be unwinding before our eyes. I just want to be really careful here because I'm not quite sure how it's going to shake out. But all roads, when you see currency moves like this, lead to gold. Peter Bookvar had a great note out on Thursday today speaking about gold demand, all the things he's seeing from the World Gold Council. As we're sitting here, gold continues to make new all-time highs. Gold is the answer. I'm just here to tell you. I mean, gold is in play. And historically, when you've seen moves like this in gold, it suggests that something below the surface is not right.
For sure. And you're referring to the World Gold Council, which came out with its Q2 data earlier this week. And I think you had a 4% year-over-year increase in gold demand, which is big in gold. That's the highest demand you've seen going back to 2000. A lot of these things are back to what periods? 99, 2000,
Right.
and 2006, 2007, 2008. The unwind. I think the reason that Bank of Japan is important, and certainly the yen has gotten the benefit, if you want to call it benefit by strengthening, of U.S. data being weaker and yields coming in. So that's just playing on that. But I do believe you're right, Guy, that as the carry trade comes unwound, you're just taking leverage out of the system, so you see things come down. We've talked about volatility in general, and a lot of these beta neutral leverage shops, when they just turn down their leverage from 6 to 5 or 4, you're going to see basically the kind of the air come out of the market, which is what you're kind of seeing here. And it felt like to me that this move in the last few days, kind of you had the sell off, then you had the rally, was kind of just a balloon shooting up into the air, that the air was coming out of it at the same. That's how it felt to me, that, going into this morning, even at the open here.
Well,
So
just think about this. On Tuesday, NVIDIA was down 8%. On Wednesday, after those results, it was up 12%.
After
Microsoft's results. And today, on Thursday, the stock traded 120. Here we are at 108. It's down 8% again. I mean, I can't remember that sort of volatility in a $2.5 trillion market cap.
We'll have the largest market cap move of any stock in history yesterday, right? It was the largest market cap move.
Just think about that. And Guy, you made a point earlier in the day about this sort of volatility. We were talking to Carter Braxton of Worth Charting, is that this sort of volatility either marks what?
Either marks a bottom of a market or a top. Now, if you folks out there that are listening to this think that somehow we're around a bottom, you're looking at something different than what I'm looking at. So I would submit, especially with the VIX now, as we're sitting here, that's north of 19, again, back on its horse. This is nothing. This does not look like a bottom to me. It looks more like what you see at tops of markets, the fierce volatility, the intraday swings without question, the big counter trend rallies, which in what I believe is the beginning of a market sell-off. This is something you have to watch. And I'll add one more layer to this. If risk on was still a thing, Bitcoin should be trading a lot better than it is. And Bitcoin's gone from 57,000 back to 70,000. As we're sitting here today, it's south of 63,000. So the Bitcoin is part of this whole unwind as well when you look at through the lens of semis and some of these other high flyers, Dan.
I think that Bitcoin gets a little bit of the retail whip that, kind of comes around, and so kind of last in, first out again. So it's going to be much more volatile. Obviously now with the ETFs, easier by gold is different. It's not held by retail. Like that's one thing that we do not see, obviously. So something I certainly look at, and
I feel like Bitcoin is very correlated to the Mag 7, if you will. And then if you think of some of the excitement around these ETFs, which gets a lot more consumers in, I think they're a lot less likely to own the actual spot. You know what I mean? So now it gives the opportunity to kind of get in through these, vehicles that people are very familiar with.
I want to make one other comment. So last week, when you saw the quote, healthy rotation come out of kind of big tech into the Russell, the comment was, okay, great. That's a healthy rotation. The money stayed in the market. With the economic data coming in weaker than expected, people worrying about the economy, that's more of a direct hit to the Russell, just in terms of businesses and smaller, mid-sized businesses being impacted by a slowdown in the economy. So now where do you go? You're going into the bond market here. I mean, you are seeing
and the equities that look like bonds. So look at today. We have
the staples are doing well.
We have the telcos up a lot, or a lot for them. We have staples up a bunch, right? And we have some of the pharma up, and there you go. And utilities. I mean, those all seem very defensive right now.
No, and again, what we're seeing, I believe, is a flight to quality in the form of the bond market, predicated on a lot of different things, as we said earlier. Slowdown. Without question. I mean, the data is what it is, so it makes sense. But how we started this and how we'll sort of end it is rates going down is not sort of the salve for the stock market. Sometimes they're going down and they're trying to tell the market a story. And we've said this as well, Danny. It's not the inversion of the yield curve that gets you. It's the re-steepening. And people will say this is a bull steepener, and they somehow hear bull and they equate that with the equity market. It's a bull steepener for the bond market. not necessarily the equity market, Danny.
Correct. We talked about that last week. It was happening in real time, steepening. Yeah. So the rates go down, bonds go up. So it's bullish for bonds in general. And we are flattening out here. I think as we sit here, we're 18 to 19 basis points. It would not surprise me, like I said, as the market builds in more Fed cuts, that impacts the shorter end of the curve, and we're going to actually go flat to probably go to a steepening, and that's going to happen. To me, the key to that is, since people say, "Oh yeah, but the inversion didn't signal a recession," well, it might have. It just was a lag effect. Is how do you use those inputs on the curve to make investment decisions, whether it's banks that are most impacted or so forth. To me, that's most important.
Yeah, and again, we're talking to self-directed folks, right, who kind of like rejigger their portfolio and the like. And, Guy, you made this point that by the time you're listening to this, we will already have the July jobs report. Here's another one. We're going to have Apple reporting tonight. We have Amazon reporting tonight. And generally, you'd say, okay, they might be stock specific, right? When you think about that. But what's different now is that the investment ground is moving below your feet right now, right? So the fact is that we have 60% of S&P 500 earnings that have already come out. And now has an S&P that looks like we're going to make a new cycle low here. When I say cycle, I mean of this last month or two since the all-time highs and since we were making new highs daily, as it felt like in June. So an Apple could really affect sentiment. I think when you look at Amazon, what they have to say as far as AWS, they're expecting high teens growth there and higher as we get to this current quarter. Well, you know what? It just bottomed out at 12, 13% a couple quarters ago. If they only come in line, okay, and their CapEx is below expectations, that bookends this whole period that we've seen. And then you're in the hands of the market. Then you're in the hands of sentiment. Then you're in the hands of really crowded trades coming unwound at a time where the macro couldn't be as uncertain as I can remember. And that goes for geopolitical, that goes for an election season, and that goes for, like I said earlier, S&P earnings estimates for this year and next that seem way too high.
There's certain things, you mentioned utilities, Dan. I'll just point this out. The XLU, if you want to play that game, made a new 52-week high today again being Thursday. Not only was it a 52-week high, it's probably the highest levels we've seen in the last couple of years. So that is not, it's bullish if you're long XLU, but if you're trying to sort of figure out what's going on, XLU making a new high in this environment is not necessarily a good thing.
Well, here's one. Danny, your Walmart is just grinding higher.
I know.
There's nothing that kind of hits this stock. So talk to us a little bit about, we talked about the trade down. As far as consumer, you mentioned Wayfair. There's like a dozen examples just in the last week where the sentiment, or at least the C-suite commentary, is just not good as it relates to the consumer. Are there pockets in retail, though, that you think that you can remain in, or correlations going to go higher if it becomes very clear that the economy is probably going to do what you guys have suggested once we start cutting rates?
At some point, Costco and Walmart will give up, will give it up.
Mm-hmm.
And there's just no way you can maintain these levels. But what do they have? They obviously have dividend. They return capital. Not that big at this point on a yield basis because the stocks move so much. But at some point, they were benefiting so much from food prices being elevated. Well, food prices actually have come down across the board, I believe. And so they probably attracted some type of consumer for a period of time. I think that the growth rate for Walmart will start to slow. I'm not going to make a call here. I still own it. I'm not selling it here. But Dan, to your point, if people are hiding in those names at these valuations, that's kind of the scary part. I want to say something else is that, again, when stocks start to go down in general on beating and raising or something, people say, oh, so-and-so disappointed. No. Investors took these stocks to certain prices that were so elevated that there was no way that they could maintain. It's not, and by the way, watch what the managements, say and do, right, on these calls. They can't control people buying their stock, right? But obviously, we go back to Jamie Dimon saying, I'm not buying my stock at 2 times book value, right? So that's the kind of CEO that you want. You want to start to listen, again, to these transcripts and these conference calls and make the decision, but don't get caught on this one side.
Wait, you don't want a CEO like Elon Musk who says that if you don't believe what we're doing as it relates to robo-taxis, then you should sell the stock? I mean, he said that on his call last week.
The other thing, yes. The other thing, banks are the last sort of group standing here. And as we're sitting here at JP Morgan, which made a new all-time high, I think of 217 and change, is trading about 207. So it's hanging in there. If you start to see the weakness in banks, and I do think you're going to see it in regional banks, but if you start to see the weakness in some of these huge banks, JP Morgan, Bank of America, which, by the way, earlier this week, we heard that Warren Buffett sold a portion of his Bank of America holdings, and he has, I think almost 900 million shares
million.
That
left.
was another follow-on sale, right?
Just keep an eye on that. So if banks start to turn, that might be the banks are perceived safety. Banks should not be trading this well in the environment that I think we're going
I'm going to
into.
let the big short guy get in here in 1 second, but this goes back to Citigroup, and I know it feels like ages ago where the banks started reporting. I think they reported on July 12th or something like that. So here we are on August 1st. I think that the Citibank CFO, he said it as it relates to retail. Do you remember he said some of our retail partners are seeing less demand, and they're talking about a weakening consumer. And I just think it's interesting that that was July 12th, and people were kind of writing it off as kind of a one-off thing as it relates to Citigroup. But to me, I just think that's all you needed to hear, followed on by all of these other retailers and consumer-facing companies.
Yeah. Private label credit cards, you've seen Bread Financial Report talk about it, obviously. Wells Fargo's the bank that's more exposed to the kind of lower middle end type of consumer. It's down the most today. I think of the big ones down 5% or so. That's the one I would kind of watch here. The Cap One Discover, they're merging, so you're not going to get really a clear picture on a standalone basis. Everybody's looking at these things on a pro forma basis. But again, the group had a big run. And now with rates coming in, it's a negative for the banks, period, end of story. It's a negative for them. And so that's, I think, what we're kind of looking at here. So, listen, banks have been trading as utilities now for a long time, and they're good stocks. They're fine. They're not in danger like they were last time.
Very crowded, though, when you think about a JP Morgan. I mean, that seems like an Eli Lilly. It seems like one of those names that people have felt very comfortable of just owning and not selling under too many scenarios.
Well, the leverage is not there. I don't think we're looking at a bank. That's never what we're saying. The valuations are extended, especially when you look at a JP Morgan, which is traded again towards price to tangible book at levels we probably saw pre-financial crisis. Just doesn't make sense to me.
It's been very hard to monitor kind of growth in the banks because a lot of the growth has been happening outside of the banks. Private credit, Ares Capital, good on them. Just raised another $34 billion in private credit for lending, right? Direct lending. That has been growing outside of the banking system now for several years. It's in the trillions. So it's much harder to track kind of the growth in loans. And these banks haven't been doing as much lending. But I'll say this, if this market keeps doing like it's doing right now, and we're only off 4.5%, I think, from the highs in the S&P roughly, the whole IPO market, the M&A stuff, all that stuff, right, people start to take that out of their model for later in 2024 and 25. And then you start lapping the same way we were lapping easier comps from 23 and 22 into 24. You start to lap difficult comps in 24 for the banking sector. So you'll start to trade on forward earnings versus looking back. So
I love to hear percussion. I also love to hear what Rebecca Patterson has to say. So on the other side, we're going to talk to her, so stick around. A warm welcome back to the On the Tape podcast. As teased earlier in the show, we are now joined by the great Rebecca Patterson. Don't say anything. So I watch CNBC.
Yeah, and you're on it, actually, quite frequently.
I am, actually. Many years ago, there was a show called, I believe it was called Money in Motion. You familiar with that show? And I would watch it from time to time because it was on sort of Fridays, and Fast Money was usurped. Is that a word? And there were a few people on that show, but sometimes it's like that Led Zeppelin song, "One Voice is Clear Above the Din." Are you familiar with that? That's off All My Love, off the In Through the Outdoor LP. Their last, by the way, studio album before John Bonham passed away. One voice is clear above the din. And as a kid, I wasn't that bright, so I had to look it up. Back then, you didn't have the Google machine. You had to go to like a dictionary. And what they were saying was one voice sort of rises above all the cacophony of sound that's out there. Rebecca Patterson is one of those voices. Your voice has always risen above the din, and we are thrilled to have you again. Last time you joined us, I believe, was right around Halloween of last year. That would be October 27th.
Boo.
A lot has happened since then. Welcome back, RP.
Well, with that introduction, goodness.
Wasn't that a great introduction?
Yeah,
wow.
I mean, you got Zeppelin, you got lots of four-syllable words in there.
Well, it's impressive, right? A man of my limited
flattered.
intellect, I'm able to pull the non-monosyllabic words. All right, so by the way, you wrote a great op-ed piece that we want to talk about without question. That's important. But last 6-7 months, here we are, end of July. What's going on? Like, what do you like? The landscape, as much as it's changed through the lens of the stock market, nothing's really changed at all theoretically, because outside of a couple little mini sell-offs, I mean, it's been lower left, upper right, all systems go.
Well, yeah. I mean, the difference between October when I was here last time and today is that most people are a heck of a lot wealthier if they were invested. And that's a wonderful thing. And I think you could say, what else has changed? The U.S. consumer has proven much more resilient than anyone thought last October. So, and then some things haven't changed. China has been unable to get itself out of its doldrums. Gold has continued to benefit in part from that, with the Chinese central bank diversifying reserves, Chinese consumers looking for somewhere safe to put their money. Some other things also haven't changed, including, polarization around the world that's leading to a lot of uncertainty from politics to policy.
It's interesting you mentioned the resilience of the consumer, and you chose that word, and I agreed. I mean, if you look at through the lens of many things, there is a resilience there, but across now a swath of different retailers, you're hearing about the slowing the consumer, the troubled consumer, trade down consumer, all these different things. One of the things that I've said, and I'm not suggesting I'm right, but I believe we're at a point now where the consumer is fighting inflation with credit, and that's typically not a good sign.
Yeah, no, I 100%. One of the great things about coming on today is that we have one of these weeks with so much good stuff to chew on as investors. You've got tons of macro with major central bank meetings, non-farm payrolls, and you have tons of micro with 34% of the S&P reporting this week. And as an investor, I've learned slowly and painfully over the years that you always want to look at both. If you're a stock picker, you still need to look at macro and vice versa. And when I look at the earnings this week, to your point, Guy, you're seeing Nestle, you're seeing Whirlpool, you're seeing McDonald's, you're seeing so many companies saying there are cracks, and especially with the lower income consumer, but there are cracks. And you're starting to see a few even with the higher end luxury retailers. So the consumer's resilient today. The question I keep asking myself is, how long can it last? And I think the key to that, honestly, is going to be the higher income consumer. They've benefited from the equity market much more. They've benefited from home ownership much more. So when do they start pulling back and get more cautious? It was interesting. Earlier this week, we had the July Conference Board Consumer Confidence Index. That's a mouthful. They break it down by income. And if you look at the confidence, you look at expectations to spend, to buy certain things, the gap between lower and upper income is not only large, but it's getting wider. And so the upper income still confident. That means the overall economy is going to hold in there. The second I see that starting to turn, I think we've had one too many cracks in this story.
Yeah, it's interesting, Rebecca. Just think about, I know you look at a lot of transcripts. You just listed a bunch of consumer-facing companies that had some things that look less resilient as you think about the consumer. And I just think about quarter over quarter. I just can't remember the last time. It's almost like a deluge of what these companies are saying about the consumer. And it seems like investors in the stock market are not particularly focused. They're focused on the secular AI trade. That's the thing that's driving, obviously, a lot of the performance. And then I think of a stock like American Express. It's up 36% of the year versus the S&P that's up 16%, and how much has come off of its recent low. It's up 80% from its late last year's. So it's speaking to that higher end consumer that just seems infallible. What is the thing that has to happen for, I guess, market participants to realize that, it's just not going to be particularly rosy going forward to the consumer? Because I think a lot of them are thinking that whatever the Fed does over the next 6 months on the rate cutting cycle is going to be the thing that bails out a weakening consumer.
Yep. That's like, can the Fed thread this needle so they can lower rates enough that borrowing costs and credit card costs, other costs for the consumer, come down enough to give them a little more spending power? But at the same time, will the consumer get helped enough? And does the job market hold up enough that you keep getting the earnings flow? You need the lower rates and the earnings. And what makes me a little cautious is that it's not what happens this year. If we get 1-2 cuts by the Fed this year, fine. But between now and January 2026, there are 175 basis points of cuts priced. That's a lot. Historically, we don't see that kind of easing unless we have a recession outside of the late 70s, early 80s. So if the Fed disappoints expectations, which has been the case for the last couple of years now, the stock market can withstand that, but only if we still have a resilient consumer. And it puts more and more onus on this upper income consumer. And again, so far they're good, but What does it take for them to get more cautious? That's what I'm watching for in as much leading data and earnings guidance as I can find. So far, we're okay. The luxury brands are getting a little bit slower, but I don't know how much is that is America versus China, right? I want to see the American high-end consumer pull back. We haven't seen it yet.
So that leads me to my next question, which revolves around small caps. Now, small caps, Karen uses this term monolith. I get it. There's a lot that makes up the small cap, whether it's IWM, whatever you look at, it's a very diversified group. But recently, and you know this, the rally in small caps, which has been long awaited, is finally upon us. But if we are late cycle, if things are slowing down, my instincts suggest it's misguided. I understand what's happening. It's the sustainability that concerns me. Talk about that.
We are in violent agreement. Valuation has been something everyone's pointed at small caps about for years now. And valuation, as we all know, is necessary but not sufficient.
Mm-hmm.
You need a catalyst, and that catalyst is usually lower interest rates and better expectations on growth. Usually small caps crush it at the beginning of a cycle. So when we're in a recession, the Fed starts cutting rates sharply, small caps tend to lead the wave higher. We're not there now. We are going to get rate cuts. Do we get enough beyond what's priced in? I'm skeptical. And do we have growth that is holding in at least steady and ideally improving somewhat or hope improving with those Fed cuts? I think for small caps to sustain this rally, you're going to need that combination of factors. It could happen. I'm not ruling it out. But because I'm skeptical on both of these legs of the stool working, I would be avoiding indices. I would be looking at very active selection in companies, and they don't just rely on lower rates and they don't just rely on the consumer. They have some other catalyst beyond the valuation that's going to drive that.
Well, let's drill down on the valuation of the S&P 500. Is it so expensive, the forward PE at 20.6 versus, this is from FactSet, versus the 5-year average of 19.3 and then the 10-year average of 17.9? If you think about the way inflation has come down, we know it's still up a lot cumulatively over the last 20 years. And you think about maybe some of the rollbacks you're seeing from some of these consumer-facing companies, might that cause the consumer on the lower end to maybe catch a little steam and maybe give some support to the double-digit expected earnings growth this year and next, making the S&P look reasonable? And if you could just throw in this secular sort of theme of AI and what that might mean for efficiency and productivity and all the like, maybe the S&P is like fairly valued at 20 and a half times forward.
Right. Okay. So I'm going to take what you said, if I understood it, and sort of try to say that again in English for our listeners.
You
viewers.
Sound like my producer, by the way.
I think what you're saying is if inflation keeps moderating, people have more purchasing power. So even if you don't get a lot of rate cuts, just the fact that inflation's coming down, assuming wages hold up okay, that's going to give you the consumer resilience or enough consumer resilience to keep this party going.
To maintain double-digit earnings growth that would justify a 20 times on the S&P 500 on a forward basis.
Yeah, I think it's possible. And even today, the valuation of the broader market to me doesn't look rich. It looks fair, maybe even full, but not, I don't think it's egregious. And I'd also just add on this, and again, I'm saying something the two of you know in your sleep, but when we're thinking about price earnings, it's an important marker. We always have to be watching it. But in terms of using it to have a successful investment strategy, it works over a 5 or 10 year period. Over a 1 year period, you might as well throw darts.
Right.
So it is a piece of data you want to watch, but you certainly don't want your thesis to rest just on that. So whether the valuation's fair or a little high, okay, good to know. Now put it in context of everything else I care about and then pull the trigger.
100% very fair. We talk about it all the time, but what I've said, and I think you would agree with this as well, the richer things get, the less room for error theoretically the market has. And that hasn't been a problem yet. We'll see.
And that is exactly what we're seeing with tech.
That's right.
Exactly.
That's exactly right. And I think that's last time you were here, I mentioned October 27th. I think it coincided with the top tick in terms of where 10-year yields was, or the low tick in terms of the TLT. They're both the same thing, effectively inverse. I get it. Since then, 10-year yields have come off significantly. The bond market has rallied, obviously. I think you actually outlined a bull case for bonds, which is coming to or came to fruition. As we're sitting here now on Fed Day, your op-ed we're going to talk about, I mean, there's still a lot of cross currents here. There is a very compelling case that I can make where yields should go higher. If the economy is slowing, there's a very compelling case why yields will continue to go lower. Today, what's your sense?
I mean, with the 10-year close to 410, I don't see a ton of room on the downside in the short term for yields, i.e. for bonds to rally further. But if I am a medium or longer term investor and I'm just thinking about my asset allocation, I'm feeling pretty good about the bonds I've put in my portfolio over the last, 6-8 months. And I certainly wouldn't be getting rid of them here. I wouldn't be trying to tactically trade this because, as we just talked about, the consumer's holding up now, but we're seeing cracks. And if there is a decent probability that those cracks spread and something breaks, I'm probably going to be pretty happy I have those bonds as part of a diversification strategy. I also, you hear me talking on and on and on all the time about gold. Still like that as part of a diversification strategy as well.
All right, so let's talk about gold because there's a lot going on in the gold market,
Yes.
And this is going to dovetail, but it's a very similar conversation because I think they go sort of part and parcel, hand in hand. What's going on with the BOJ since your last appearance with us has been fascinating. I mean, you think about the weakness in dollar yen, the subsequent intervention we saw in April, the subsequent weakness in the yen again, and now this last round of intervention and rate hikes, which has now gotten dollar yen from 160 to 150-ish in a straight line. There are a lot of ramifications for that, but all roads, to me, lead back to gold, and we're seeing it in terms of the price action. So you don't have to agree with that sort of the way that I synthesize it, but there's no doubt something's happening in the gold market.
Yeah, I mean, over the last year, I think the big drivers, again, have been coming from China primarily. The fact that the Chinese central bank has been buying huge amounts to diversify reserves, and the Chinese consumers have wanted some place to store their wealth that felt safer than local assets. But, thinking about the yen and what's happening in Japan since we all spoke in October, I mean, it's been a historic period for Japan. They exited negative interest rates and yield curve control after years and years and years with those policies. And then just this week, we had the Bank of Japan raising rates again, laying out a quantitative tightening policy, suggesting rates could go up further. We had dollar yen getting to its highest level, the yen at its weakest level in a couple of decades, multiple rounds of intervention. I mean, a lot going on there. And the Japanese stock market outperforming most of the world for several months this year. When was the last time you saw that? Now, Japan has come off its highs in terms of stocks. To me, couple big takeaways. One is that what happened in Japan should be a reminder to everyone listening to us that currency matters. On January 1st, if you bought the Nikkei or Topix and you just bought it whole with the yen, you made 5%. If you hedged out your yen, you made 15%. I prefer 15 over 5. I don't know about y'all. So that's one takeaway. You can't ignore currency effects when you're figuring out where to allocate overseas. I think second is to keep it in context. The beginning of the year, all the analysts on the street were super bullish on the yen, thinking it would strengthen because they thought Japan would leave negative policy. And Japan did. And guess what? The yen kept weakening because it was incremental, and the bigger deal is the Fed. The bigger deal is the dollar. The dollar represents almost 90% of all currency trading in the world. The yen's an afterthought. It's a price taker, not a price maker. So the move in dollar yen now from 160 to 150, so the yen strengthening pretty quickly, I think a little bit of that is the Bank of Japan. I think a lot more of it is the fact that people think the Fed's about to start easing in September. And we had extreme positioning in dollar yen, extreme valuations, and more intervention. So it's the combination of all these things. So again, my other takeaway is make sure you're taking a look at the bigger picture. It's so easy, especially with financial media, and I love them, but sometimes you'll get uber focused on one aspect of it. Being narrowly focused, you can miss the forest for the trees and lose money in the process.
Let's talk about yields here in the U.S. So you mentioned that, the 10-year at 4.1. Obviously, we know that the 2-year is more closely tied to what the Fed is going to do with their interest rate policy. We see the 2 years down to 4.35. And so would you say that, again, like the Fed just came out, the pressure's going on right now, we'll have all the digestion of that, on Thursday a little bit, but you think that we have kind of run ahead expectations, at least in the 2-year, for what the Fed might do between now and the end of the year? And the last thing I'll just say is, you mentioned the polarization that we're seeing around the world. We're looking right now at crude up like $3 because of, the Israeli strikes in Beirut and also in Iran. Does that run the risk of, okay, maybe inflation kind of picking back up again? And if we've had yields kind of run ahead of what the Fed might do, maybe we just don't get all the cuts that a lot of folks are pricing in right now.
Yeah, no, good, lots of good points in there. I mean, the escalation in the conflict in the Middle East this week with the Hezbollah and Hamas officials being killed following the attack on the kids in Israel, which was horrific. Yes, we're seeing a big rally in crude. I've liked having energy exposure in a portfolio, partly valuation, partly dividend yield, partly a geopolitical hedge. And you can play it directly in the energy market, of course, but for equities, I think it makes sense to have some exposure there too. The Fed doesn't explicitly target food and energy. We know that. But we know that they look a lot at inflation expectations, and those are heavily influenced by food and energy. So they do care about oil prices, and oil prices tend to lead inflation with about a 6-month lag. So if we were to see oil prices creep up higher here and sustain that, that is something that could affect what the Fed does next year. And as I said earlier, there's a lot of easing priced in. So to your point, the 2-year here, we've had a big rally in the 2-year, a big drop in the yield. There are risks in both directions. If the consumer cracks and the economy slows faster, that Fed easing might be justified and we're not running ahead. If the consumer, especially the higher end consumer, can hold in there, and especially if, unfortunately, if geopolitical stays front and center, then the 2-year might be pretty fair and sticky here.
You a fan of Dwight Eisenhower by any chance?
He is not one I know as well as some others.
No, fair enough.
I'd say the love of my life would be the Roosevelts.
Is that right?
Both FDR and Eleanor.
And Eleanor.
Yes.
Look at you.
Yes.
I mean, it's fantastic. No, I mentioned Dwight, I believe it's David Eisenhower. I think, by the way, Richard Nixon's daughter married Eisenhower's son. I don't know if you knew that or not.
I did not.
Anyway,
good to know.
That's what you learn here.
Yes.
Well, he was the supreme commander of the Allied forces in World War II.
He was also president of the United States.
34th president.
I mentioned, look at you. Did you Google that or did you know it?
Don't worry about it.
Since basically the Eisenhower administration, whether they believe it or not, every sitting president talks about a strong U.S. dollar policy.
Yes.
We want a strong U.S. dollar, which I get. I mean, it makes sense. If you're thinking about it, if you're a citizen of this country, I want the dollar to be strong. President Trump was the first president in my recollection that actually openly talked about dollar's too strong. Dollar's way too strong. Now, by the way, in a lot of ways, he was probably right in terms of the competitive nature of our goods and all those. I totally get it. But man, oh man, that is a complete 180 in terms of what's going on historically. Your op-ed talks about a lot of these things. And I think recently now candidate Trump has talked about the dollar being too strong and all those things that are completely counterintuitive, but they're out there. And your op-ed addresses a lot of these things. It's not political. It's just looking through the lens of the economy and what could potentially happen in what could be another administration. So let's sort of get into that.
Yeah, but let's give this op-ed its due. I woke up this morning, I pull out the New York Times. I don't really pull it out. I pull it up on my phone. You know what I mean? And so is the New York Times. How Trump's ideas could seriously mess with your financial life. And again, to Guy's point, I read it. I didn't think it was like overtly political one way or another, but you're basically breaking down. We know what the current administration, that the current candidate for president is likely to continue with. We also had 4 years of the Trump administration where we probably probably have a good sense of how that shapes out if he were elected again. So I think it's important to kind of take, take stock of how things might shake out.
Historical context.
Yes. Exactly.
Yeah, well, I'll go back to Eisenhower. If you go back over decades, different administrations doing the best they can with their views and their ideologies for the country will put different policies forward. And every policy, any decision all of us make every single day has costs and benefits. And there are some times in history you look back after the fact and say, wow, that policy, I knew what they were trying to do, but gosh, that had costs that we didn't even imagine. And I think you can argue, after China joined WTO in 2001, there were huge benefits. Millions of people around the world lifted out of poverty. There were some pretty darn big costs within developed economies with workers whose jobs were outsourced.
Absolutely.
And that was a cost that I think in hindsight, a lot of people regret. And so with those sorts of things in mind, and we've seen that happen in both parties, this isn't political at all. This is about policy costs and benefits. When I look at former President Trump and some of the policies he and his advisors are putting forward, things like making permanent some of these tax cuts, possibly trying to weaken the dollar, broadening and escalating the trade war, and while it has been denied, some discussion of reducing the Fed's independence, take those things just by themselves. Together, my worry is that they could have an unintended cost that would be a big deal, and that cost would be undermining the U.S. Treasury market. The Treasury market, $27 trillion market, biggest in the world by a lot. It is our golden goose. Americans can borrow cheaply. Companies can borrow cheaply. The government can spend cheaply because everyone owns U.S. bonds. If we make those bonds less attractive for cyclical or structural reasons, then suddenly all our lives become more expensive. To me, that's a pretty darn big cost. And I wanted to write this piece not to criticize the policy necessarily, because I think where they're trying to go, build jobs for manufacturers, make our companies as competitive as possible. That's great. Who's against that? No one's against manufacturing jobs or competitive companies, but think about the possible costs. And if the costs are too high, take a step back and say, is there another way I can achieve my aim?
Yeah. The irony of the trade war, back in the Trump administration was that it made a lot of goods a lot more expensive, or the input costs that for our manufacturers here, you know what I mean? And then they never really brought jobs back into the U.S. But I want to go to the tax cuts, which you just mentioned, because again, they are set to expire in 2025. And when you think about that $1.4 trillion tax cut, okay, that they borrowed from the future, they gave to corporates, they gave to, very wealthy people, and then what happened in the stock market? $1.4 trillion of equities got bought back by corporations over the next 2 years after that. So again, I find that policy really interesting. And then the other point, and you mentioned this in the op-ed, is that if they were to extend, those tax cuts, then over the next decade or so, you have $4.6 trillion that would be added to the deficit. Now, last point I'll just make is that, we've had a lot of people on the podcast on Fast Money, and they say, don't worry about the deficit. As long as I've been in the markets or in the business, everyone says they're worried about the deficit. They're worried about the deficit. And I've made this point a couple times. I had a closed door dinner, about 20 people. There were investors. There were some media types. Byron Wien, it was probably one of the last meals that he had or where he spoke. And it was one of the last things. And I remember this. He said, worry about the deficit. He said that to this group of people. But Guy, every time we talk to somebody smart in the markets, they say, don't worry about it. The chickens are not going to come home to roost. Talk to us about that.
So I hear you. I've been in the markets as long as you have, I think, more or less. And I have heard the deficit and debt doomsayers for decades. Ooh, look at that alliteration. And it hasn't happened, right? People keep buying our debt. They aren't going elsewhere. And so it hasn't played out yet. And you wonder—
Can I ask one question, though? Because you mentioned China.
Yeah.
It's hurting China. Think about all the debt that they have, right? Think about here where, our growth has been on average, 2% or so for 15 years or something like that. And think about how much debt was put on sovereign balance sheets after the financial crisis. And so I just think that ultimately it is having an effect. It's dragging on growth all around the world.
So what I worry about most with the debt and deficits is not necessarily a day we wake up and we have, like the UK in 2022, after Liz Truss proposed more spending and tax cuts, and the markets just collapsed there until the Bank of England bailed it out. I'm not so worried about that moment here, again, because of the size of our markets and the depth of the markets and the fact that the Federal Reserve has shown time and time again it will do anything it can to preserve the credibility of the bond market. It views that as part of its job. So we're in a better place than a lot of countries. At the same time, the more we keep spending like this, and as you said, 4.6 trillion over 10 years, if these tax cuts are extended, we lose fiscal space. That means we don't have as much money to put into research and development on technology, into defense, into childcare, healthcare, you name it. Now, some politicians say, well, the government should be out of those things anyway. Let the private sector take it. That's a choice, right? And that's going to be another one of those policy decisions that we'll only know 20 years from now. Oh, did it actually make sense to privatize education? I don't know. I don't have a good answer to that. But I do worry a lot about losing fiscal space at a time when our country is getting older and the costs and needs of that elderly population, they're depending on Medicare, Medicaid, Social Security. Government's not going to have room to pay them that. So something's got to give. I mean, Social Security is the obvious choice just to reform it, but politically it's too much of a hot potato.
Third rail, no question.
Yeah.
I mean, and again, I've heard the doomsayers as well. I'm probably one of them. But you get to a certain level where debt to GDP it gets to that 130%-ish, which historically, and you can go back to the beginning of mankind, no developed economy's ever been able to recover from it. And we are right at the doorstep. And unless magically GDP starts getting on its horse, that's only going to get worse in terms of that ratio, I think. So
that's such an important point you just made.
You have to watch it.
Right. You absolutely do. And if you're going to have debt growing like that, you have to, I mean, the G has to go faster than the R. You've got to have the growth. Right now, America is in a beautiful place, right? We have tech companies that have such a huge comparative advantage versus the rest of the world, and that should help grow through productivity over the next decade. We don't know how much yet, but it should happen directionally. Climate, we're going to be in a much better place than much of the rest of the world because we're not as hot as other places, and we have the means to help ourselves with technology. Demographics, we're not in a great place, but we're much better off than most of the rest of the world. Our labor force is still growing. Now it's growing at half the pace it was growing at a decade or so ago, but we're still growing. And with immigration, even if we control it more than we do today, we're still going to have a growing labor force, whereas China, Korea, Japan, most of Europe, shrinking. So there's a lot of structural forces that should help the growth in the U.S., help absorb that growing debt and deficit situation, but it's still a big question mark. Is it enough G? And are we being careless, not spending more attention on the G and the R, right? The interest rate as well as the growth.
You a GNR fan by any chance? Not at all.
I know a lot of
appetite
people,
for destruction.
I have. Are you familiar with my Spotify playlist, Rebecca, or no?
I am. You have, and both of you have an amazing recall for music.
That.
It's quite
first of all, he
extraordinary.
calls it a playlist. It's just
Every
your
song.
album. It's just your library. That's what it is. You have
I really don't. When you say that, I don't understand
It's
the
just your
difference.
library. It's not really a playlist.
It's a playlist.
Sorry, I got us off track here.
On my Spotify, which is approaching 900 songs now, there's one Guns N' Roses song. That would be November Rain. I have more Carpenter songs than I do Guns N' Roses songs. I'm off the track here. But with that, so quickly, debt service is a big deal. I mean, we talk about what is, in your I know that's a very difficult question to answer. You know, everything seems to be going swimmingly. It's one of those things like if nobody moves, everything's going to be okay. You're in sort of the bank and nobody moves. And then invariably, like in the movie The Rock, somebody knocks a little stone off and everybody gets spooked and all of a sudden, and everything starts to, starts to fly around. What do you see? What is that stone out there? Is it China, Taiwan? Is it an escalation in the Middle East? Is it some sort of craziness around the election here? Or is it just some unknown that we can only then talk about ex post facto?
I think it could be any of those things. And to your earlier point, the larger the debt mountain gets, just like valuations, the higher the valuation gets, there's no room for error. The higher our debt gets, the less room we have for error. And it could be a number of things that could be that proverbial tipping point. I don't think we have the same risk that most other countries do because of the depth, liquidity, and the Fed backstop. But it doesn't mean we're risk-free.
All right, so a lot of talk about hard landing versus soft landing. I think most of the crowd out there think that we're headed for a soft landing.
Yes.
Give us something that you're generally optimistic about. There's all these, listen, we priced in a recession at the end of 2022. The stock market took off. I think this generative AI thing obviously had a lot to do with it. People were excited then. They're still excited about it now. What do you think the probability is that we, see ourselves in a soft landing scenario and we really don't have a recession at all? I mean, the last recession we had was obviously COVID. It was short-lived. It was a lot of monetary and fiscal were thrown at it and seems to be causing the very wealth effect that you've talked about that have kept the high-end consumer really intact for all intents and purposes. But it seems like, again, like just to kind of put or bookend this thing as the way we started, it just seems like the resilient consumer is becoming a lot less so. So what is the probability that we hit this sort of soft landing?
So obviously the Fed's goal is the soft landing. The Fed can't control everything. They can't control the electoral outcome and the policies that happen afterwards. That's going to matter a lot because the Fed might not be able to respond to everything or understand the implications of everything in terms of feeding through to their mandates. What's happening in the rest of the world is going to matter a lot. China had its Politburo meeting this week, and they came out and they're talking about amping up stimulus. So far, it's been this slow drip feed of stimulus, which has been more focused on manufacturing than the consumer, and it's not doing what they need it to do. That could change. So that if we see enough stimulus from China and they get a little more growth momentum, maybe closer to their 5% GDP target or above, that could be positive and help underscore the soft landing narrative. A ceasefire in the Middle East, just from a sentiment perspective, would help the soft landing narrative. Maybe oil would come down a little bit. That would help purchasing power, like you were talking about before. I don't rule out the soft landing narrative at all. Right now is not one of those moments I'm pounding my fist on the table on a view. But I think at the end of the day, it's probably close to 50-50, soft landing or something bumpier. And to your point, the market's pricing in a soft landing. So the risk to me is skewed that we have something a little bumpier. So when I think about what would I have in a portfolio today, I mentioned this already, but I do want to have some bonds, even if yields aren't falling a lot from here in the soft landing case, maybe even rising a smidge. I like having some gold here. I like having some energy exposure here, geopolitical risk hedge, which could come in line with the bumpier landing. But then I still want to, I'm not abandoning tech. I wouldn't necessarily be adding a lot right now because it's still, even with the pullback, priced pretty well. But I think there's a structural trend there, and I would prefer not to try to get cute and time going in and out of it. And then I want to stay away from things tied to the lower income consumer. Looking overseas, I'll tell you one I'm not pushing hard for yet, but I'm pondering. And maybe next time I'm back, I'll be on pondering and have something concrete to recommend. But the UK is cheap as chips, cheap as UK chips. And you think, okay, valuation, necessary, not sufficient. So what changes the picture? Well, having a serious, stable government in there, and I'm not making a political comment. It's not about the party. It's just about having a government that actually says, okay, here's our policies. Here's what we know we need to do, and they'll be in power more than a month. So having more stability to the government and a government that wants to improve ties with Europe, get some more trade going with Europe. You have the Bank of England, maybe even this week, starting an easing cycle. We're speaking right before the Bank of England decision. They may cut 25. They may push it for another month or two, but they're going to ease this year. So you have lower interest rates. You have government that's gone from chaos to stability. You have extremely low valuations. Is there a case to be made that this could be a piece of a portfolio that might not be in total synchronicity with the rest of the global tech, small cap trade? So it's something I'm digging into a little bit right now. I'm curious about.
The voice you've heard for the last 33 minutes has in fact risen above the din, in this case, the din being the voices of Dan and myself, and that is Rebecca Patterson. I hope it's not another 6 or 7 months before you join us again, but you certainly will be back.
Thank you. I would love to come back.